So I've been getting a lot of questions as to what are my top 5 favorite ETFs. So I'm going to do that breakdown today for you specifically. We're going to open each one of the fun fact sheets and we're going to break down each of the 5 ETFs, why I love them and why you should maybe consider them in your portfolio. With that being said, let's get into it. All right, today I'm going to show you my top 5 favorite ETFs. Okay, disclaimer. Number 1, do not blindly copy these ETFs. Number 2, do not use all these ETFs together, as that would not make any sense. And number 3, this does not mean these ETFs are suitable for your portfolio. And number 4, if you want to get this right once and for all for your personal portfolio, go in the show notes below and download my course today and start this journey for you and your personal portfolio. Okay, with that being said, let's get back to the video. Today, I'm going to show you my top 5 favorite ETFs. We're going to walk through each and every one of these as to why I like them. And then I'm going to show you my personal portfolio as well. So let's start with the first one, VTI. This is a very straightforward type of deal. Now, I will say, all of these products today, 4 out of 5 of that are Vanguard based. So these are Vanguard backed products. And so if I were to buy these, I would typically purchase it on Vanguard. Now, there's no reason you shouldn't be able to purchase these elsewhere. Like, you could buy VTI and Fidelity, and that crossover effect does not have any transaction fees, which is fine. But I typically, if I'm going to buy these types of funds, I'm going to buy these directly through Vanguard, and that's just best practice. Stay at home is kind of how I say it. So with that being said, guys, VTI is a phenomenal fund. As it implies right here, it's literally the total US stock market. So when it says total stock market, it's not the total world stock market. It is the total US stock market. So if you ever click on this right here, Admiral shares, you can always see the similar index fund. So I do not own VT-SAX anymore. I own VTI because they allowed, as of October 2024, the total transition from index to like-kind ETF. If you want to make that switch, it's free. There's no taxes. Even in a taxable account, it's pretty cool. So VTI is a really, really great fund for obvious reasons. It's the total US stock market. When I'm looking at one of these funds, what am I actually looking at? I'm going to go over some highlights here. So specifically, this expense ratio is big. Like, the cost of this fund is extremely important. And Vanguard actually just lowered across their all their funds, they lowered their expense ratios in pretty significant ways. But here, 3 basis points is phenomenal. Typically, if it's below 20 basis points, I'm totally fine on. So that's one of the first things I look at. But before I even look at that, to be honest, I'm looking at like what this fundamentally is. So the rule 101 is like, invest in what you know, right? A lot of people are just like buying VTI or buying these ETFs or stocks because, you know, they see somebody like myself mention it, but they don't actually know what it is. So what is VTI? Well, the product summary is going to tell you specifically what that is. You can obviously like imply up here, it's an index, it's domestic stock, meaning, you know, US based, it's general, it's a large cap stock. You know, you can figure out what it is, kind of make sense of it. But if you go to the product summary, this seeks to track the performance of the CRSP US Total Stock Market Index. So literally the US market. This includes large, mid, and small cap equity diversified across growth and value. So when you're looking down here at the style box right here, that's what this is referring to. The large cap, mid cap, and small cap. There's portions of that in this specific fund. Okay, so what is large, what is mid, what is small? That is the size of the share price times the total outstanding shares, and the size of that is comparable to the market. Okay, so large cap is 10 billion plus, mid cap is 2 to 10 billion, and small cap is anything below 2 billion, just for reference here. And then obviously you have value and you have growth. So as it kind of implies, a value-based fund, something that's really good quality on the market from a value-based perspective, something like CVS potentially. Then you also have something like growth, think of like Tesla or something like that, right? So you have growth, and if you have a blend, you have both in there. So if you go back up here and you think about how this kind of talked about from a product summary standpoint, it has large, mid, and small cap equity diversified across growth and value. Now, because predominantly this is large cap, and that's what's really driving this fund, that's why you see this up here in large cap blend as a total style box perspective. Okay, so you go to the very, very top and you see domestic stock general large blend. That's exactly why, because most of this is being driven by the large cap stocks in this, just because of the size of them, right? This employs a passively managed index sampling strategy. This is something that's very important. I love passively managed funds. The reason why is because this guy does not cost a lot of money. Again, I like to say under 20 basis points. Again, it's not always perfect, but that's what I love. And then you can see more details as to this if you want to see it. The fund remains fully invested, low expenses, minimize net tracking error, and then you can see all the details here. Okay, fund management's Vanguard Equity Index Group, nothing to be surprised there. And then you can go down down here and actually see the summary on the total returns. You can see quarterly, annually, cumulative. I typically, I think it's a very novice way to look at a fund. If you're just looking at like, I've seen a lot of people do this. So that's why I'm bringing this up, is like they'll jump to performance of fund and they'll just look at these numbers right here and say, which one's the largest? I'm going to go select the largest. And that's just not how you invest, because context is really key. So if you think about this is the US based fund. So the last 10 years have been really good. But if you look at the future 10 years, that does not mean that's going to play out the same. In fact, based on Vanguard's predictions, it's not going to play out the same. So making a fund choice based on just purely like their 10-year average or 5-year or 3-year or 1-year is very short-sighted. It's something I definitely want to look at, but I'm not going to like obsess over, because I've seen a lot of people jump to this as soon as they start opening funds. That's like the first thing they go to. So I want to bring it up because you're going to see it, but I don't want you to make decisions based on this. Now, next is down here at the bottom. You can see the actual breakdown portfolio composition. And of course, you can click this instead of scrolling down like I'm doing right now. So number of stocks, there's 3,600 US stocks in this, which is an incredible amount of stocks. So when I talk about like diversification, when you buy one ETF, this is why you get so much diversification. Now, exposure is important. So you're obviously getting domestic US exposure. So you're not touching anything else besides US domestic equity exposure. And that's something to, obviously point out. However, for that exposure that you are getting, you have quite a bit of stock here within this one ETF. So when I talk about 1 to 5 ETFs is plenty for a portfolio, this is exactly why. So think if you had, 4 ETFs, they all had thousands of, stocks. Think how many stocks that actually is. And think if you went to buy that individually, would you think that you're diversified at that point? Probably yes. So always be very careful about, just loading up with multiple ETFs, because what they are fundamentally is a group of stocks or, whatever asset you're buying. And then what you really want to do is see down here, you can actually see the breakdown of the portfolio composition a little more by the actual sector of the market. Okay. So there's 11 different sectors and you can see the general breakout. And what I want to point out is this technology part. So one of the funds I'm going to talk about today is specifically technology backed. Okay. And so when you think about this, when you have a VTI and you have 34% of that fund is specifically technology, you got to be careful about getting other exposure in technology, because that's going to even go higher than 34%. So if I put $100 in here, $34 would basically be allocated to technology stocks. Now that might be the future. You might have an argument as to why that makes sense, whatever the case is, but just remember the exposure you're getting with just VTI alone is 34% into technology. And so going into picking other ETFs or other stocks, have that in the back of your mind, because that's a really important piece of this. That's a huge portion of this ETF in particular. And then obviously you can see the other ones as well, breakdowns if you want to see those. If you ever put like $100 in or $1,000, if you're like, hey, where does my money actually go? This is specifically where it is by portfolio composition. But even further, you can actually see the holdings, which is obviously a huge part of this. Okay. So you can see 6% of this fund is going to Apple. So when people are breaking these out, I think it's really important to understand like where your money is actually going, because I don't think people actually have a true concept of that. They just go to, oh, what's the general stock market? But then you get freaked out because you're like, I don't know what's going on really. If you really fundamentally understand what you own here, obviously know you own the total stock market ETF, but to be specific, you own 6.08% of Apple. So every $100 you put in there, $6.08 is going straight to Apple, essentially. Microsoft, you can see $5.26 or 5.26%, and so on and so forth. And so these are the top 10 holdings right here. And as you can see, even the 10th holding, which is Berkshire, Class B, is only 1.41%. Because we have 3,600 stocks, as we talked about up here, 3,600 stocks. So there's a lot of stocks. There's a lot of things that are going to be like 0.1%. And so you are spreading your money out in a massive way here, which is really important. So obviously the market kind of goes in fluctuations, especially like this specific exposure. If the US experiences a downturn, most all companies are seeing, their value drop essentially. Therefore, it kind of moves in one, which is important to note as well. However, realize that you are spread out between thousands of companies with just this alone. So that's a really important piece of it. Distributions is also a very important piece here, because I know a lot of people like dividends. And so I don't personally go for like dividends. That's not like what I'm like chasing. I'm not looking for high dividend payers. And this is not a high dividend payer, but you will get dividends nonetheless. So if you see, you can actually see like the breakouts of this. So like 94 cents a share was recorded 12/23, paid out 12/26 of 2024 is the last quarter when I'm recording this. By the time this video goes public, I would assume Q1 2025 has already happened, and you'll probably go in here and you'll probably see the new payable and record date as well. But as of now, when I'm recording this this obviously is showing specifically the dividends, and you can go backwards and see how the dividends increased, decreased, whatever the case is. Obviously, you see here, 2023, the dividend was like $1 and it's decreased to 94 cents here. And it actually went down to 87 cents and went back up to 94 cents. And obviously, that's going to fluctuate with time. But again, that's not my goal here. That's not what I'm chasing. However, comparable to other funds I'm going to show you in a second, this is actually much lower. And I'll show you which ones I'm talking about in just a minute. So this is VTI. You can obviously look at fund management. You can look at like the actual portfolio managers down here if you want to. I don't think that's that important. If you want to see like the full version of what we're looking at here, just do view prospectus and you can see that. If you want to see other things, obviously that's important. One thing I did not talk about yet was fees. So if you hit performance and fees, you can actually see right here in this little area the fees that are allocated to this specific fund, which we talked about the 3 basis points, which is important, but there could be other fees at play. Now, this is why I love Vanguard, because there's not a lot of fees, which is awesome. But you can see the average expense ratio of similar funds is 77 basis points. And again, I said don't go over 20 basis points as a rule of thumb. So this is 3. This is phenomenal. So this is VTI. This is my favorite ETF by far. This is the largest portion of my portfolio current day as I'm speaking. Okay. The next fund I want to talk about is VXUS. So this is pretty much the exact opposite of what we just looked at. Instead of the total US stock market, this is the total international stock market. Okay. So this is a little different than what we just talked about, but it's important to see the same exact things across the board. So it's still an index. It's still pretty cheap, relatively speaking, 5 basis points, a little more expensive. And instead of being a large domestic equity, we're looking at a foreign, meaning international, large blend as well. So this is international and global stock. Now, some people have home bias and they think that nothing happens outside of the United States. I don't believe in that, and I look at it a little differently. Historically speaking, guys, VXUS as a fund hasn't been around for too long. One of the things I talked about in the first thing was looking at their performance and stuff like that. So the reason why we talked about the 10-year, the 5-year, 3-year, 1-year, etc., is understanding the context, but also inception date is important on top of that, because the inception date here is January 26, 2011. Okay. So if I'm looking at this fund and I'm looking 10 years historically speaking, and it's 2025 when I'm talking, this fund has only been around since that time period, and so that's only a very short time period in the big grand scheme of things. But also, if you actually understand that time period on a macro trend, you realize the US dominated, international did not do as well. So you're going to look at this fund and say, oh, 5%, that sucks, that's horrible. But you're going to look comparably to VTI and see that 12% we just looked at, and you're going to say, well, wouldn't VTI be better than VXUS? That's your natural, way to go. Well, yes, performance-wise, since inception, yes, it has outperformed 100%. But if you look at anything historically, and specifically this chart right here, you're going to see that the US and international equities will kind of go back and forth a little bit. Now, historically speaking, the US index has definitely outperformed, or the US market has outperformed international, but the goal isn't just the max return possible, because you also have a huge downturn potential with that as well. And everyone feels okay when the US is riding high and like they're outpacing international, it's fine, but there are trends that will happen. And so based on this sheet right here from 1975, you can kind of see the back and forth. And so you can see the US outperformance over the last 13.8 years, and into 2025 that has shifted already. So does that mean, and I don't know, does that mean international starts to outperform in the next couple years or not? I don't know. But this is why I like to be diversified, because we have to consider everything. And also in the grand scheme of things, it's not just about the largest return possible. It's about considering all things when it comes to investing. So when I look at VXUS, I'm going to see a lower return over a 10-year period, but that's because the last 10 years, the US has dominated and has seen a huge return. And again, if you look at this picture, that kind of reflects this as well. So does that continue? And like I talked about VTI, that 10-year, 12% return, does that continue? Well, based on Vanguard and all the other big guys' expectations, that's not going to be the case. So I don't know. I'm not going to act like I know or predict. Nobody knows out there. So it's not that I just don't know. It's nobody knows. And if anybody says they know, they're saying that they know the future, which seems kind of odd. So anyways, with that being said, I do like VXUS in a big way. If you look at the product summary, this is going to be tracking the performance of FTSE Global All Cap X US Index, which measures the investment return of stocks issued by companies located outside of the United States. This is broad exposure across developed and emerging non-US equity markets. So this is not just like one location outside of the United States. This is really broad. This is extremely broad. Some people disagree with that approach. Some people love that approach. Just kind of depends what type of investor you you are, what exposure you want specifically. Do you want just China? Do you want just Europe? Or do you want a broad exposure? I personally like broad exposure because different markets are going to do well at different times. And instead of guessing which market is going to do well, I like to have it all personally. So again, what the cool thing about this is it's following a passively managed index replication approach, which is always good. And of course, it's Vanguard Equity Index Group. Let's go down to specifically the fees that are associated with this. And again, not a whole lot of fees, which is phenomenal. Just this expense ratio and comparably 87 basis points with other international funds with their costs. So this is a really, really good fund to have to own. And then you can also see down here, let's go down to the portfolio composition. You can see the number of stocks, like I said, 8,500 plus stocks here. So like I said before, like you're owning thousands. So if I just owned VTI and VXUS, I literally own almost 12,000 stocks together, 3,600 plus 8,500. We're looking in the 12,000 range. So like two funds for a two fund portfolio has 12,000 stocks, and you have international and domestic exposure in the equity specific sector. And then you can obviously look at any other details here if you want to. If you will go down here and actually look at the regions or the markets, you can see the specific breakouts. Like you get 15% exposure to Japan. So like if you wanted to capture one of these markets in particular, and you're like, hey, I don't want Germany as part of this, or I don't want Korea as part of this, that's fine. But this fund would not be for you, obviously, in that situation. You would have to understand which exposure, which country do you want. You'd have to go find a fund that's equivalent to that specific area. But you can look at regions as well. So emerging markets, Europe, Pacific. This is an important piece here. So emerging markets is almost 27%. Let's just call it 1/4 of this portfolio. So one of the funds I'm about to show you is specifically this guy. And so if you own VXUS and VWO, which I'll show you in a second, you have to take this stuff into consideration. Same thing with like other index funds. If you own VTI and you have Apple, like we talked about, at 6% of that fund, and then you go buy Apple stock, you have to understand what your true exposure to Apple is. Most people consider that two separate investment holdings, but they're one and the same. Let's say you put $1,000 into Apple over here into the VTI, you have $60 would 6% would be going into Apple. Whereas if you buy Apple stock, then you have 100% exposure. So the combined total of that is really the true exposure you have to that. So as you can see here, if you do have emerging markets or VXUS, you have to make sure you take that into consideration. And I'm going to talk about that in a second as well. You can then see obviously the equity holdings down here. This fund, the top 10 holdings aren't as large. As you can see, only 2 of these are over 1% of the total holdings, but that makes sense because there's 8,500 stocks. So like the highest one's Taiwan Semiconductor Manufacturing at 2.48%, but even number 10 is 0.65%. So there are a lot of funds in this, or a lot of stocks and companies in this, and you have to take that into consideration as well. Like there's a big distribution of funds. So that is VXUS, and that's a big portion, or a solid portion of my portfolio as well. And again, I will show you the breakdown of my portfolio here shortly at the very end. Okay, so the next fund that we're going to look at is VWO. So VWO is, like we just talked about a little bit, Vanguard FTSE Emerging Markets ETF. So again, very similar but different, okay? A little more expensive, 7 basis points, still well within 20 basis points. It's diversified, but it's emerging markets in particular, so up and coming markets internationally. The management styles index, it's international global stock, okay? So as we look at this, we understand the product summary is a little different than what we just looked at, which was a very broad-based international fund. This is more targeted to specific regions. So as you can see here, invest in stocks and companies located in emerging markets around the world, such as China, Brazil, Taiwan, and South Africa. Okay, so these are the 4 areas that they're hitting hard in this emerging markets. And again, if you remember VXUS, it had 26% of that fund was going to specifically emerging markets. So if you broke over their regions, you would see these different areas being displayed. So the goal is to closely track the return of the FTSE Emerging Markets All Cap China A Inclusion Index. This has a high potential for growth, but also high risk. Share value may swing up and down more than that of stock funds that invest in developed countries, including the United States. And why is that the case? If you have an up and coming, or let's just say an emerging market, there's a lot more volatility. It's similar to like a smaller company versus a larger company. That larger company or that larger developed community is more stable, so therefore there's less volatility, but maybe less upside. With the lower, let's say a small company or a smaller up and coming region, they have a lot more growth potential, but they also have a lot more volatility. There might be politics at play. There might be other things at play that play a significant role in the growth of that area. However, historically speaking, emerging markets is a very big winner. However, there's a lot of volatility that comes with that. And so I don't make that as a big part of my portfolio, but I do have a portion of my portfolio that goes to emerging markets in particular. But with that being said, like we talked about with VXUS, I do take into consideration the emerging market exposure within VXUS. So as you continue to see, only appropriate for long-term goals. So if you're doing something short-term with this thing, it will be very rocky. Also, the sizing that you put in your portfolio is important. If you have a huge portfolio of emerging markets, you're going to just have a crazy swing and you might not be able to sleep at night. But this is Vanguard Equity Index Group, obviously, as we talked about. We talked about the fees as well. So 7 basis points. The average, expense ratio of similar funds is 1.14%, which is way too freaking high. Do not touch anything above 20 basis points, but geez, that is high. And as you go down here specifically with the portfolio characteristics, we have 5,000 plus stocks. So if I have a 3-fund portfolio, VTI, VXUS, and VWO, as you can see, we talked about 12,000. This is going to be like up to 17 or 18,000 total stocks. You can then see the breakout, basically emerging markets, as we talked about, a little bit in Europe. You can see the markets specifically here: China, India, Taiwan, Saudi Arabia, Brazil, South Africa, and you can see the percentages allocated. And then you have all these other little guys all over the place, like Chile, Greece, Philippines, Hungary, Colombia, like very small portions, but nonetheless, we have this, okay? And then you can also see the breakouts of this. Now, because this fund doesn't have as much, there's a much larger holding with Taiwan Semiconductor. Remember, the last fund, VXUS, was like 2.64 or something like that percent. This is 9.11%. It's a much larger holding to that. So if you're putting $100 in there, 1/10 of that, $9 almost, is going strictly to this specific company. So important to note, Tencent is obviously a huge company in the world, but they dropped to 3.7. And then by the time you get to the 10th largest holding, it's 0.86%. You can also open by page, and you can, if you want to go down that whole rabbit hole, like what are all of the holdings, that's important as well. And then down here, you can see the dividend, income, and distribution. Now, you will see a much typically larger with international holdings from a dividend perspective. My dividend with VXUS in particular is much larger than VTI. And so I get paid a pretty large dividend from VXUS. But as we talked about with VXUS and international holdings in general, there are a lot higher of dividend payouts, and that will be reflective, obviously, within your portfolio. And depending on what portfolio you're holding this in, is it retirement, non-retirement, your taxes will be applicable as well. So it's important to understand that on top of this. All right, so my next fund is VT. Now, this is why I did the disclaimer in the beginning, is like all of these funds together wouldn't make a whole lot of sense because there's a lot of overlap, number one. But number two is if you had VT, which is a really solid fund, we'll get to it in a second. This is the total world stock ETF. And as we just talked about, we talked about US, we talked about international, we talked about specifically emerging markets. Now we get to a total world ETF, which literally will show you, it's encompassing all of the stuff we already talked about. So some people will do a 1-fund portfolio with VT because they get basically the global exposure and it's much easier. Okay, so this is 6 basis points here. This, as you can see, is literally world stock. So this is going to be US and international. So you can see international global stock index, all the stuff we just looked at. If you go down here, this is important, the product summary. So invest in both foreign and US stocks. This seeks to track the performance of the FTSE Global All Cap Index, which covers both well-established and still developing markets. So you're literally getting everything. Has high potential for growth, but also high risk. Share value may swing up and down more than the US or international stock funds in particular. Only appropriate for long-term goals. And then obviously Vanguard Equity Index Group. If we look at the portfolio or the fees first, 6 basis points, really, really reasonable. And I'll get to that in a second as to why you can get that lower actually with a very similar weighted average approach with the 3 funds we just talked about. But as you go down here and specifically look at the portfolio composition, you have 9,800 stocks with this one index. So that's obviously near 10,000 stocks within one fund. So one fund approach, if you just want, global equity exposure, it's not a bad approach. You're not going to get as much small and mid, involved with this, but you can obviously always add that kind of stuff within there if you want that exposure. I do know a lot of people do use this fund just because it's a lot simpler and easier. If you look at the regions, emerging markets is 9% of this. Europe is 13%, Pacific, North America is a big portion. So if you look at North America versus all else, you're looking at like a 67%, 33% allocation. So if you want, you could also model your portfolio after this with a different set of funds to then mirror this, but also get lower expense ratios on, a weighted average basis. So as you can see here, our holdings are very similar across the board: Apple, Microsoft, Nvidia, Amazon, Meta, et cetera, et cetera. And you can obviously see all of those if you want, Taiwan Semiconductors in there. Obviously, it's a much smaller portion across the board just because these big guys have such a heavy weighting. But again, you're really diversified across everything. So if you just want general total world ETF, VT is a really good option. It's not to say this is the only option, but this is a solid option. Okay, so the next fund is QQQM, and this is going to look a little different through it's Yahoo Finance, but it's also because it's not Vanguard specific. It's Invesco NASDAQ 100 ETF, QQQM. The reason I like this one a little more than QQQ, which you might hear often, and there's a few other ones as well, is because the actual expense ratio is much cheaper than the other ones by 5 basis points in particular. So when you look at this and we look at the actual summary right here, ETF summary, the fund generally invests 90% of its total assets in the securities that comprise the underlying index. NASDAQ Inc. compiles and maintains and calculates the underlying index, which includes the securities of 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market LLC based on the market capitalization. It's non-diversified. So as you see down here, specifically the 15 basis points is much lower than the 20 basis points with QQQ. And so it's a very similar type holding, but it's actually cheaper and newer. It's kind of like the new guy on the block. And that's why I like this one over the QQQ basic fund. It's a large growth. The Morningstar style box, which Vanguard also uses, as you can see here, is a large cap growth fund. So there is no blend here. It's purely growth. There is no value within here. So it's not a mixture of both. It is large cap growth. These are high growing companies. It's a very important thing to know here. So you can see the performance, which is good to see, and you can see it by the actual year as well. So 2021, you had 27% increase, but then 2022 was a 32% increase. So the stock market as a whole, S&P 500 that is, was about a 20% decrease that same year. So this is going to have a lot more volatility, a lot more swings up and down. So it's great when you get the upside, but also you got to be prepared for the downsides as well. And you can look at the holdings specifically for these. So you have a lot of the big guys, but a big piece of this is obviously the technology sector of 51%, communication services of 15%, and then obviously consumer cyclical of 13%. And then you have a few other of these guys, very, very small portions after consumer defensive and healthcare. But this whole technology sector is important to know. So if I have a VTI type fund and I have 34% of VTI is technology, and then I get a fund to complement VTI and it's QQQM, I just have to realize my technology sector is going to go way up the roof, and I had to be prepared for that. And it's okay. There's nothing wrong with it, but I have to understand that's part of the play here when I'm bringing in technology. It also has a lot of overlap. So if you're looking at these funds comparably to a VTI, the top 10 holdings are very similar. Apple, Nvidia, Microsoft, Amazon, Broadcom, Meta, Tesla, Netflix, Alphabet being Google. There's a lot of the same holdings. And so a lot of times people will get into a fund like this and then also in other funds and not realize there's a lot of overlap. And so when I said in the beginning, a lot of these funds won't make sense together, this is exactly why. You just have a lot of overlap when you do add funds like this. So when you look at this fund as a whole, there is a lot of overlap, and as long as you're aware of that, it's not a bad fund to add. And I really, really do like it. It's just a matter of understanding how it kind of fits within the bigger picture. And so the next piece of the puzzle is I want to show you actually my portfolio as well. And so before I say this, I want to explain that when I talk about my portfolio, I want to define what that means. That does not mean my real estate. That does not mean my Bitcoin. That does not mean my individual holding position like Meta. That does not mean any of that stuff or private equity. This is just my equity portion of funds. So when I look at this, I look at my retirement funds and I will also look at my non-retirement funds with this. But even within there, my retirement versus my non-retirement looks a little different. I'll show you as well as that. So when I'm looking at my retirement portion, I have 3 fund portfolio. I have VTI, I have VXUS, and I have VWO as 3 of my funds in here. But again, like I said, VWO has a lot of overlap within VXUS. So I had to be aware of that. And so VTI is roughly 80% of my equity holdings in my retirement accounts. VXUS would be about 17.5, and then VWO would be about 2.5. Now that again does not include my Meta position or anything like that. And when I look at my non-retirement portion, I actually have a 2 fund portfolio from the equity portion side of things. So I have VTI and VXUS. And again, you don't have to overcomplicate this game. It could be super simple. It could be very, very direct, very, very straightforward. And as long as you bring in the time aspect of it, the contribution aspect of it, and a very simplified portfolio, and again, VTI and VXUS comprise of about 12,000 stocks, you are very well globally diversified. You have diversification in the equity sectors. And obviously, I'm not talking about my real estate, my Bitcoin, my private equity, or my Meta position. So there's other things of diversification within the grand scheme of things. But for my equity portion, it's a very simplified approach, about an 80-20 approach of my non-retirement and about an 80-17.5 and 2.5 in my retirement. Now, again, like I said, that does not mean you go do this or go duplicate this because that might not make sense for you in your particular situation. I understand my situation very very, very in depth. I've walked through different quizzes, profile quizzes. I understand my risk. I understand my goals. I understand all of this stuff that led me to specifically this allocation. Now, in the show notes below, like I said in the beginning, you can start this process so you understand what you should actually do. So these are my top 5. This does not mean these are the only top 5 out there. This does not mean I don't like other funds like SCHD, for example. But there's a reason I brought up these top 5 because I think these are applicable to a lot of people listening to this based on the situation. If you're following me and you're in my type of situation, these could make sense. But again, go in the show notes below, do the program, walk through every single step, and you will have your outcomes specifically that makes sense for you. That's exactly the steps that I went through to get to this conclusion. So I did not start with this conclusion or ask somebody, what stock do I pick? I went through all of the steps I talk about in my program so that I can show you step by step of to how to get to your own conclusion, and you're teaching yourself, which is awesome. So with that being said, guys, I hope this was helpful, and I will talk to you next week.